Very good evening, ladies and gentlemen. I am Sanjay Das, hosting today's webinar. On behalf of NSE, I welcome officials from Ministry and SEBI, officials from Indian corporates, media, academics, and last but not the least, esteemed trading members of NSE. It's quite commendable how all of us are managing home and office together. Thanks to the government for managing things pretty well. Now I request Ravi Varanasi, Chief Business Development Officer, to give a welcome address. Most of you would know Ravi has spent over 25 years at NSE, heading different divisions. In his present role, he heads trading and business development functions of equity, equity derivatives, currency, and commodity derivatives. Over to you, Ravi.
Thanks, Ajay. Good evening, ladies and gentlemen. Welcome to this webinar on global oil markets, which we are organizing in collaboration with ICIS. ICIS is a leading information provider for energy and petrochemicals markets. I thank speakers from ICIS for agreeing to do this program and share their expert views on the oil markets with all of us. We are going through absolutely exceptional times. None of us have ever seen anything like this. COVID-19 pandemic has impacted the world in ways no one has imagined it to. Governments across the globe have imposed lockdowns of varying variety, varying severity to arrest the spread of the virus. While the lockdowns are having an impact on the spread of virus, there has been a severe and widespread impact on the economic activity. Governments are working on unwinding the lockdowns and kickstarting the economies. The lives versus livelihood debate is raging on across the globe. As economies slow down, catering only to essential goods and services, oil demand took a severe beating. While the demand slumped, efforts to manage the supply side got into a series of geopolitical issues initially. Finally, the OPEC and its allies announced a historical deal to cut the production last month. But the output cut may not be sufficient to restore balance in oil markets quickly. Rising crude inventories will continue to exert pressure on oil markets, and therefore the volatility is expected to continue for some more time. All this turmoil resulted in WTI crude futures plunging to negative territory on April 20th. Brent crude prices, which are the international benchmark, have also seen price drops, but remained well in the positive territory. Indian crude basket, as you know, is linked to Brent. About 2/3 of world crude oil transactions are pegged to Brent. That's one reason why we at NSE have decided to launch derivative products on Brent crude rather than WTI. While our experts from ICIS would delve deeper into the matter, I would want to just say that logistics and market dynamics makes Brent a completely different proposition for the market players. The critical difference, obviously, is between these two is Brent is a waterborne crude, while WTI is a pipeline delivered crude. Market forces can move waterborne crude from region of excess supply to one of excess demand. There are relatively few constraints, and the frictions in this process of supply is not significant. Therefore, the market equilibrium can be achieved far more easily. Pipelines, on the other hand, are far more rigid. So obviously, the demand and supply equilibrium is far more difficult to achieve. These logistic issues, among others, led to WTI prices going to negative territory in April. We believe that Brent crude going to negative territory, while theoretically possible, may not actually happen. Having said that, we are tweaking our systems to handle negative prices as we talk. In an exceedingly volatile market environment of today, it is imperative for the market participants to understand the dynamics of the market as closely as possible and get a grip on the levers that impact the prices so that they could navigate efficiently through these troubled times. That's the rationale for holding this webinar and for bringing experts in the field for you. Please use this opportunity to understand the market dynamics and the levers, price levers. Please ask questions to clarify any doubts you may have. I don't want to stand between you and the experts here. I have a couple of housekeeping announcements to make. We are recording this webinar. We will transcribe and circulate the same among our members. We will try and circulate a Hindi version for your use. That's it from me. Thanks once again for attending this webinar. Back to you, Sanjay.
Thank you, Ravi. It is indeed a great day to have international speakers addressing us today. Let me introduce them one after another. We have with us Sophie Udubasceanu, Global Crude Oil Editor at ICIS. Sophie is based out of London and oversees both futures and physical markets in Europe, Africa, CIS, Asia, and US. Prior to the crude oil, she focused on European electricity, gas, and renewables. Regularly based out of London, Sophie oversees the crude oil team round-the-clock coverage of the world crude market in the above geographies. Next, we have Ignacio Stolongo, Senior Oil Editor based in the US. Ignacio is an expert in the US physical market and having spent 30 years at ICIS Houston office, brings a well of knowledge. We have Richard Price, Global Oil Deputy Editor. Richard is an expert in crude oil market and a very familiar face at international conferences. He supports World Crude Report team at ICIS in the 360-degree coverage of the global market. And we also have Ajay Parmar, Senior Crude Oil Analyst. Ajay is a Senior Analyst in the Products and Analytics Division at ICIS. He is the price-focused lead for the global oil and refined oil products and regularly provide insight and analysis on these markets. Ladies and gentlemen, now I pass it on to the ICIS speakers. Over to you, Sophie.
Hello, everybody. Thank you, members of the NSE, for the warm welcome. And welcome to everybody to our joint ICIS and NSE webinar. Thank you for the introductions. Once again, I'm Sophie Udubasceanu, the Global Oil Editor, and I lead our team of experts, some of them joining us today for this session. So I'm going to start today. I'm going to start the webinar today by talking about our ICIS Brent fixings and also to the NSE settlement and also the methodology behind them. So to kick us off today, the Brent fixings are published at 5 individual timestamps throughout the day on expiry day. This is generally the last working day of the month. The timestamps that I mean are 10:30, 12:30, 2:30, 4:30, and the close. Now, these include our assessments for the front month M1 of the cash PFOE contract. These assessments feed into the FSP, also known as the final settlement price.
1 minute, सिर्फ sound आ रहा है, हो गया होगा.
I'm going to ask everybody who, if you don't have any questions, if you don't mind to mute yourself to continue a smooth webinar today. Okay, so as I was saying, the NSE FSP uses these assessments, particularly the M1 cash PFOE, that is the front month contract. Now, the calculation behind it includes 3 components. The first one is the FP for the second month. This is an ICIS assessment and based on market information. The second component is the futures price for the second month. That is the last trade on the ICE Futures Exchange. And then the third component is the cash spread between the M1, the front month, and the second month. So M1 and M2. This is also an assessment and is also based on market information. So, at the moment, we do offer these assessments in real time to our subscribers on expiry day after each timestamps. We aim to deliver these assessments within 30 minutes of each timestamp, depending on how quickly we are able to confirm with the market the information. Now, the assessments of our EFP and our M1 versus M2 spread is based, like I said, on information from the market, data that's coming from the market in a timely manner. We use the latest bid offer or trade observed in the market. We do exclude information that is deemed too late to be actioned upon, and we have a few more details on this if anybody's interested in our methodology that is published on icis.com/crude oil. Now, it is worth noting that our trade data and our price assessments are also used in the ICE Brent index. Now, the exchange makes this calculation for their index using each individual window. The index becomes obviously the average of all these windows. They also use different components as well. They also include trade data. So ICE uses trade data for each window individually. This is why we provide to our customers, to the ICE exchange, and also to the NSE, exact timestamp for each trade. DFP, these concerns trades for DFP products, spreads, and also cash BFOE monthly contracts. I've also put in here a screenshot of the ICE methodology with the various data sources that ICE is using. So as you can see from there are different components where they do use the minute markers. And you can see that the source, we have ICIS as a source for most of those. Now, ICIS is the only PRA currently providing information to ICE. And this was kind of like a quick explanation of how the index is calculated. And again, you have more information on their website. Now, again, why we use it the way we do is because this methodology count and basically offsets any low liquidity we might see on the M1 cash BFOE, any high volatility on the front month ahead of its expiry, and it is based on true market value. So now we obviously have seen what may happen if the front month contract faces low liquidity and high volatility. An example is the WTI negative prices that we saw in April. Now, it is true that WTI settles mid-month as opposed to the end of the month, which is what we see on the ICE exchange. Again, let's kind of like dive deeper into what drove these negative oil prices. First off, a quick kind of like roundup of what the trading activity looked like for that week, the week starting the 20th of April. The settlement then was $37.63 minus. That is a historical low, and negative prices definitely attracted a lot of headlines around the world that same evening and also the next day. The contract was expiring on the 21st of April. So even on the 21st of April, we continued to see some negative prices with an intraday low of just over $16 per barrel. The settlement on the 21st was actually in positive, plus $10.01, but this obviously had a massive jump day on day. If we kind of like look closer at this, at what really drove these historical low prices for WTI May contract, was basically a combination of different factors. One of them was expiry, the closing of positions ahead of the expiry of the contract. As I said, the contract was expiring on the 21st of April. There was also a lot of panic selling, about 15-20 minutes of panic selling for those who had long positions. And that was mainly because participants wanted to avoid to take delivery of those contracts. Now, of course, this was also partly driven by concerns about the lack of storage. So, for example, there were fears of storage filling up in the US. Today, I have a great privilege to ask a few questions to our ICIS oil expert in the US. So, Ignacio, would you be able to share a bit of insight onto really what happened to participants with long positions and what was the root cause of these negative oil prices? Ignacio?
Can you hear me now?
Yes, we can hear you now. I think you're gone.
Thank you for the opportunity to more or less discuss what went on that particular day. A bit of a background here. When the NYMEX established the West Texas Intermediate contract back in 1983, it was mainly used by refiners in the US Midwest and Mid-Continent to lock in their refinery supplies. Therefore, the NYMEX established a mechanism by which refiners could take delivery of the oil. And at that time, most of the production was stored in Oklahoma, in a tank farm called at Cushing, Oklahoma. So it worked fine. But let's remember, we call it WTI, West Texas Intermediate, or light sweet crude. It's really a commodity. And what you buy on the NYMEX is actually a paper contract. And each contract consists of 1,000 barrels of oil. And it works fine because when the contract expires, the buyer or the holder of a contract can take delivery of the oil or unwind the position. You unwind your position or you roll it forward to another month. But it became an investment product. And it's being used by hedge funds, money managers. And what we saw happen on that particular day, actually, it was confined to the financial market. There were a few hedge funds who got caught long, and they did not want to take delivery of the oil. Therefore, they had to unwind the position. They went into the market to sell, and they couldn't find any buyers. And as you see on the screen, it was very small volume. And it only happened in the last 20 minutes of trade, which is what we call MOC, or money on close, or trading at settlement. And when they couldn't find any buyers, the price plunged. Now, if they don't find buyers, of course, they would have to take delivery. And the storage space at Cushing was beginning to fill up. Therefore, there was some serious panic selling that particular day. And of course, buyers decided to stay back and see how low it would get. When it got to around minus $40 and into negative territory, somebody bought it. And the next day, the contract expired. As I mentioned, this was confined to the financial markets. And could it happen again? We don't know. But if you saw the small volume that drove prices sharply lower. A normal contract, as you could see in that slide, is 2 million barrels per day, roughly. 2 million contracts. That particular was 247, and the next day, 18,000 contracts. You had a case of, unfortunately, saying that the tail wagging the dog here, where a small volume drove the price down, and of course, everybody panicked. I would say the markets realign in value. At ICIS, we focus on price discovery of the physical market. And everybody can see in the media where these contracts expire, whether it's Brent, WTI, you can find that. And of course, we use it. But when we assess prices, we actually talk into the market and we see where the other crude oil grades are trading. We focus on the physical market, whether it's in Europe, the North Sea, the Med, Asia, and America. And as you can see in this slide is the crude oil grades that we assess in the US. Some of the key grades, like Louisiana Sweet, or Mars, which is a sour high sulfur material. When WTI finished down $37 in negative territory, LLS traded at $50 a barrel. It realigned in value. Normally, LLS trades at around $4 or $5 premium to WTI. In this case, it maintained a certain amount of the differential. That's why it traded at $50. And if you see that in any market, whether it's West Africa, whatever, supply and demand always plays a role. And oil demand right now, of course, is way down because of the lack of the virus. But we're beginning to see a gradual recovery in demand. As the economies begin to open, we are seeing oil demand more constructive. And as I said, this was disturbing, of course. This going into negative territory is disturbing, but it was not the end of the world. We are beginning to find these markets now beginning to recover. I hope that helps. Back to you.
Sophie, you are muted.
To unmute.
Apologies. Thank you very much for that, Ignacio. So here we see the different forward curves, what we were seeing in April and what we see now. Now, if we, Ignacio, if we kind of like, let's look at how the US production kind of features on a global scale. Obviously, we naturally saw US output dropping. How are smaller US producers reacting?
Of course, this is impacting production all over the world. We have seen OPEC and Russia, some of the others, attempting to cut production. And the US is doing its share, but it's happening gradually. Let's not forget, these are independent oil companies or majors in a free enterprise situation. The government cannot necessarily mandate these companies or force these companies to cut production. It's going to happen based on supply and demand. And what we see here is the rig count in the US for shale oil, the shale production. And it's beginning to take a toll because the oil cannot be moved. And it's going to happen basically without the government having to intervene. And it is, we need to be, keep looking at the inventories, which will coming out later today, and see what the situation is. Storage remains an issue. And we need to figure out exactly what's going to happen there. We have to keep an eye on that. Yeah.
Absolutely, and that's true. Now we have seen a steep contango that's been encouraging injections into storage, and this helped build quite a bit of floating storage as well. Now we do see the contango narrowing slightly. I'd like to invite our expert on North Sea, Richard Price, to shed some light on the storage situation.
Thank you, Sophie and Ignacio. So I'm going to be talking initially about floating storage, then I'm going to look at storage in the US. So, I mean, the impact of coronavirus on the sort of floating storage situation has been twofold. We've seen the short-term demand destruction, which has massively devalued nearer-dated contracts and steepened the contango, which has incentivized traders to try contango plays to capture as much of this contango as possible. So this has increased floating storage. And also, because of the demand destruction, on-land storage is filling up, which is forcing market players to look to floating storage. So throughout April, demand for floating storage, as well as major producers ramping up supply before the May the 1st supply cut, really increased VLCC rates. However, looking at this week, we've seen VLCC rates fall massively, which is likely to push more crude into floating storage in the near term, even as the contango shallows, which is what we've seen recently. Current estimates suggest there's around 200 million barrels of crude currently floating, which is a large number, and that is increasing a lot. So this increased around 20% in the week before last, and this trend is likely to continue. So some estimates put it as up to as many as 200 tankers could possibly end up being chartered for floating storage. Now I'm going to talk about a little bit about the US crude stock situation. So this slide sort of gives you an overview of US production, refinery input, etc. So if you look at the blue line here, this shows US production, which is dark blue. This has declined by around 1 million barrels per day since early March, which may seem like a lot, but this pales in comparison to the enormous 4.1 million barrels per day drop in US refinery input, which is this, this yellow line. And the gray bars across the bottom, these are the changes in US crude stocks every week. So I've highlighted in red weeks in which US stocks grew by greater than 10 million barrels per day. And you can see this trend where in the more recent weeks, in the last 5 weeks, we've seen 4 stock builds over 10 million barrels. Whereas if we look, the chart goes back to January 2017. In the prior months before the coronavirus pandemic, there was only 2 stock builds greater than this level. So we're now at a stage where US crude stocks are just 2% off all-time highs, which was in March 2017. So now I'm going to take a bit of a deeper look at US crude stocks. Sophie, could I have the next slide, please? Thank you. So this is a deeper look at the US crude stocks. So this is the regional distribution of US crude stocks into its 6 main areas. So the bars, each bar shows the net stocks as a percentage of working storage capacity. So the gray bar on the left is how full inventories were on the 17th of January, and the blue bar on the right shows where inventories were in our latest bit of data. So you can see that storage has increased in fullness massively over this time scale. But the most obvious jump is that of the crude at Cushing, where we're now at a stage where we're around 80% of working storage capacity is full. And as Ignacio touched on earlier, this was in part one of the reasons why we saw negative WTI prices, because the expiry of the futures contract can result in physical delivery of WTI to Cushing. But as there was no space there, this was something that many players were trying to avoid, and particularly hedge funds. So then if we look at the rest of the can we have back, please? Thank you. So there's two bars on this chart that are very important. So if the second bar, which is the Midwest, and the fourth bar, which is the Gulf Coast. So these 2 storage areas, these pad districts, account for 83% of the total US storage. And even though we've seen a huge demand void as a result of the coronavirus, these the little red dots above those bars represent previous historical peaks. So even though we've seen this demand decrease massively, we still are below recent historical peaks. So if you'll notice, Gulf Coast is around 12% lower, and the Midwest is around 15% lower. But we've seen around a 10% growth in both of these areas in the past month. So we could surpass these historical peaks in the next 1 to 2 months. And if you look to the bar on the right, this shows total US crude stocks, which are around 61% full. This might not seem like much, but you've got to bear in mind that we have seen a 10% growth of this in the last month and a half. So the main question I guess this poses is, will the US crude storage full? It is possible that it fills, but this would take time. So if we average the stock build we've seen over the last month, the last 4 weeks, this has averaged a 14.5 million barrel stock build. So that would fill if we extrapolate this and continue it, it would fill the 256 million barrel of storage remaining in around 18 weeks or 4 months, which is a long time. And we'd expect demand in the US and the rest of the world to have improved somewhat by that point. But there are some important caveats we have to consider when we're discussing crude stocks. The first of which is that the EIA have said that operational requirements mean that this working storage capacity and, well, the effective fullness can be reached before working capacity reaches 100%. So effectively, working storage capacity cannot be filled to 100% because some space has to be kept available in the tanks for receiving new deliveries, tank-to-tank transfers, blending, and other routine operations. Another caveat, number 2, is that Cushing, where we've seen this enormous growth, is the delivery of these WTI contract, the physical delivery of WTI contacts. It may be a small town of just a few thousand people, but it's the US's major pipeline crossroads and a key oil storage hub. So even if storage in the rest of the US still has capacity available, tank topping in Cushing is going to have really bearish repercussions for the US crude market as a whole. And finally, and probably most importantly, and this is something we've heard traders telling us about in Europe, crude storage could be a secondary issue as as inventories of refined products are likely to reach capacity prior to these crude inventories. So for a refinery, if inventories of one individual product, probably likely to be a part of the lighter portion of the barrel, because this is where we've seen the demand destruction linked to the coronavirus with gasoline and jet fuel. If inventories for one of these products reaches capacity, then they're going to have to shut off operations completely, which is going to cause crude to back up into the system and cause greater inventory builds in US crude stocks. So finally, what about Europe? Could I have the next slide, please? Thanks. So European storage situation is a lot more opaque than the US. We don't have an EIA who are giving us regular updates on stock data. However, this can be the 2 ways we can really look at this is by speaking to people in the market, traders, which is what we do on a daily basis as part of our job at ICIS. And they have been raising concerns that many refiners are on the brink of reaching this product storage capacity. Another thing that we have is our pricing information. So we assess the physical differentials and outright prices of 58 crude grades around the world on a daily basis. And this chart here is showing you the average outright price of US crudes versus the average outright price of their European counterparts. So in the last 2 years, European crudes have historically been fetching crudes in the US, crudes in Europe have been fetching a higher price than those in the US. But recently, as you can see, the average US outright price has just flipped above that in Europe. So what does this mean? Well, in the short term, it means that US competition is likely to be lower because refiners in Europe are not going to be buying US crude because it's more expensive. But it could be a signal that the storage crisis, the sort of media hype around the US storage crisis, it could be shared with Europe as well. And the European storage sites are beginning to fill up. And that is why we're seeing lower European outright prices. And as I said, this is something that's been echoed by traders we speak to. One source in particular said that they have released the fact that they're closing refiners, but they believe other refiners in Europe have not been as open about this as they have. Thank you.
Thank you, Richard. Thank you, Richard, for that insight. And yes, it's true. We are seeing not only storage for crude oil, but also for refined products getting filled up. We're gonna now have, let's say, a bit of a bigger overview on the global oil markets. First off, something that we all know about. The market has really been impacted by the coronavirus. It was a three-pronged attack, been impacting travel, the industry, and the economies around the world. Now we have seen that prices fall, especially in the oil market. Lockdown restrictions that started off with China, then spread around the world. Many factories and heavy industries and construction sites still remain closed. Now there are basically plans for an easing of these restrictions, and we are seeing some businesses come back. In terms of economy, there are fears of a potential recession. China's GDP growth was revised down. We have, however, seen countries rolling out economic relief packages. Overall, the virus outbreak did impact demand around the world, started with China, then moving on to Europe, Iran, and South Korea. India, the rest of the world, the US, they were all really they felt the weight of this outbreak. we are seeing some parts of the world recovering. China especially is slowly coming back. But however, of course, there are these issues that even if that China does come back, if its main markets are still facing similar issues, then its recovery is not going to be as swift. Now, moving on, our senior analyst and expert as well, and in oil, Ajay Parmar, would you like to share some insight with us on what to expect really, and what are the key factors to watch in, let's say, the upcoming months? Obviously, we have the OPEC Plus deal. We still have demand, an improvement in demand that may ease the supply glut. However, obviously, we may see the reaction from refineries. So, Ajay, please tell us what are the key things that you recommend we keep an eye on?
Hopefully you can hear me okay. I'll start with oil demand, and it's worth just highlighting the fact that this whole kind of oil price crash that we've seen more recently is primarily demand focused. There are supply issues, oversupply issues, but it really is oil products demand driven by the lockdowns across the globe, which has really led to a drop in oil demand overall. So gasoline demand has been hit really, really hard. Of course, passenger car travel is significantly down globally. Diesel demand, whilst lower than originally forecast, it still bears better than gasoline because the transportation demand is still required during the lockdown. Many cargoes and deliveries of products are still required. Of course, fuel demand overall is almost negligible as passenger travel is restricted across the globe. But it's that real loss in demand for refined products, which has then led to squeezed refined product spreads, therefore squeezed margins for refineries, and that has led oil refineries to reduce their crude oil, their throughputs, and reduce crude oil demand overall. And that's how it's the whole of the supply chain all the way up to crude oil. So the impact that we've seen on refinery throughputs is a 25% decrease in the US and Canada year on year. India's refinery throughput has decreased by 45% and Europe by 41%. Quite significant numbers there. Just worth highlighting the US and Canada refinery throughput decrease. There's a significant decrease considering the fact that the US is on average, has the most complex refineries on the planet. And one big indicator of how bad the situation is for refineries right now was very recently the product spread for gasoline in the US turned almost turned negative. US is the largest gasoline consumer in the world, as I mentioned, some of the best refineries in the world. And so those product spreads for gasoline have historically been extremely high. And so for that to be almost negative in recent weeks is a big indicator of just how bad the refining industry is feeling right now. But overall, that oil demand has been, oil demand has been down by 30% in April. Looking forward, what do we anticipate? Well, we still think oil demand will be under 20% or 20% down compared to last year in May. And over the coming months, it really just does depend on how individual countries respond to the coronavirus and how they lift their lockdown measures. Of course, we're looking generally across the globe as a lifting in various countries, and it's going to be a gradual lifting rather than an immediate back. So it's still a decrease on year in May. That gradual decrease will gradually decrease. That will gradually decrease as time goes on. We do think, especially for the rest of Q2, demand will really be focused in Asia, as countries such as China and others have recovered more quickly because they faced the issues earlier than Europe and the US, for instance. So over onto production. You can see here, we can't talk about production without mentioning OPEC, of course, the big, large oil producing conglomerate. You can see over the past year, oil production by OPEC has been largely 29 million barrels per day, under 30 million barrels per day, generally. But you can, this is because oil supply was, we had an excess of oil supply over the past few years. And so since December 2016, OPEC and other oil producing partners, such as Russia, have been reducing their throughput oil production as per a number of these agreements. But that latest agreement broke down in March, and that's why you see a quite significant increase in production from OPEC in April as the individual producers wanted to regain market share. But one thing that's really worth just noting from this graph is that we were already in an oversupply situation, and OPEC over the past few years, or OPEC Plus over the past few years, has seen just a few million barrels, 2-3 million barrels per day decrease in production as sufficient to help balance the market, or at least the majority of the way of balancing the market. The demand drop that we see now of 30 million barrels per day or so, much more different situation, and that's why OPEC reacted. You can see there that OPEC is expecting to reduce their throughput by 9.7 million barrels per day, and that's come into force only a few days ago at the beginning of May. So what does the supply outlook look like over the next few months? So you can see on the graph on the right, OPEC plus oil supply decrease is forecast decrease by 9.7 million barrels per day for the next 2 months until the end of June. And then beginning of July, we're going to see a decrease of 7.7 million barrels per day. So a drop in the decrease, if you like, as they expect demand to recover somewhat by then. But also other oil producers such as the US, you could see this is the EIA forecast of where the US will be in terms of oil and NGLs production over the next few months. And by the end of the year, it's expected that oil and NGL production in the US will have reduced over 2 million barrels per day, again, quite a significant decrease there. Also wanted to touch on other major oil producers such as Canada, for instance, quite a producer, 4.5 million barrels per day roughly. A majority of that production is based in Alberta, and that produces some of the thickest oil production, some of the most heaviest oil in the world. But their prices have been extremely low over recent weeks, and they have quite high production costs as well, $55 to $60 per barrel at the low end as well. So they're really feeling the pinch, and they have in the past. Alberta has reduced production and has coordinated that across the many different producers. And there's a very strong potential that this could happen as well with Alberta and Canada overall in the coming months. So what has the impact been on, I'm just going to zoom on the US in particular, which is the graph on the left there, which is the oil rig count. Oil rig count has decreased significantly, down to 325 as of the last count at the end of last week. That's a 50% decrease in the last 7 weeks only. Massive decrease. And this, unlike the previous situation when we saw oil prices decrease back in 2016, this is a different situation. Back then, shale oil was the investment into rigs was based off oil prices anticipated at over $50, $60, $70 per barrel. We're not likely to see that for a very long time now, and banks for a number of years have not been quite so willing to bankroll oil rigs. And so with their break-even prices in shale in the US at around $40 to $50 per barrel, it's going to be extremely difficult for this market, this oil rig count, to recover significantly as time goes on. And just one final point to point out, when do we anticipate that oil market will rebalance? When does supply and demand kind of converge a little bit more than we're seeing right now? We don't anticipate that those cuts from OPEC Plus and other producers are going to be anywhere near enough this month, and certainly not next month either. But as the virus lockdown restrictions do get removed gradually across the globe, we do anticipate that around Q4 sort of time, we could see a much more closer convergence of oil supply and oil demand. And that's when the cuts from OPEC, those more significant cuts from OPEC lasting until the end of the year, that's when they will really kick in to help balance the markets a lot more.
Thank you for that, Ajay. So yes, so basically, if we look at the overall market outlook, there are still some concerns over a possible recession. As Ajay says, we are still seeing economies recover. Will they recover swiftly enough? That is a very good question. Now, another key thing that I feel like is quite interesting, or at least one point to make, is that China expects another virus wave in October. Now, this brings the question of how will oil demand react to that? Is it going to be as severe up to everybody else? Perhaps Ajay, any thoughts on this?
Sorry, I think you cut out a little bit. Is there which particular thing were you asking on?
Ajay? I was asking about a possible second wave later year, at the end of the year. How is this going to impact oil demand?
Yeah, I think there's going to be less of a severe reaction overall. One of the real key points that that you guys have mentioned early on in this webinar is the point about oil inventories. Inventories are massively high, extremely high right now. Inventories in China prior to this crisis were also pretty high as well, because a lot of the independent refineries did want to take advantage of their yearly quota, and those who had an excess surplus on being allowed to purchase more oil took advantage of that and filled up their oil inventories. And of course, that kind of wasn't a particularly good idea in the end overall, of course. But I think inventories overall will be pretty high by then anyway. But I think in general, I think people will be a little bit more prepared and will anticipate this a little better, with a lot of the measures just generally in the workplace being put into place already. A second reaction is going to be a lot more well prepared. That doesn't mean that oil demand won't decrease significantly. It will, of course. But I just think that there should be a little bit more preparation by then in managing inventories a little bit better.
You're on mute.
Yeah.
Can you hear me now? Hello?
We are able to hear you now.
Perfect. So, Richard, you and I were talking about a possible double dip in Chinese demand.
Yeah. So
any thoughts on?
I'll keep it brief because I am conscious of time, but this is something we've been hearing a lot from traders, particularly focused in the Mediterranean market, where a lot of crude grades are exported to China and West Africa as well. Chinese demand has recovered recently. ICIS, our China office, collects a lot of data on Chinese refinery run rates. So independent refiners, which make up around a quarter of the whole Chinese refining ecosystem, their run rate has increased from around 30% in February to over 70% now, with a similar trend also being shown by major refiners. One of the issues that has been raised is that as exports from China are unlikely to recover, given that lockdowns in many of China's main markets have been extended. This means that Chinese exporters are going to find it hard to find homes for a lot of their goods, which means that Chinese demand may experience this double dip, which could even coincide with a potential second wave in October. So this would definitely negatively impact Chinese demand. I wonder if Ajay would quickly touch on why Chinese refining run rates has increased so rapidly recently.
Yeah, very quickly touch on that. Yeah, it is quite astonishing how the Chinese refining throughputs have bounced back so massively. It's because the margins are stronger than elsewhere in the world. They are artificially stronger, that's worth noting. They have a pricing mechanism where they have a floor in their product prices that keeps up the overall refining margin if crude oil prices are significantly high, or your refined products prices relatively high. There's a lot of money to be made. It's worth noting, though, it can only continue for a certain period of time. So eventually, when there's so much product being produced in China, they'll be exporting again. And when they're exporting to the rest of Asia, who hasn't quite yet recovered quite as well as China has, those prices will be decreasing. Those refined products prices will be sold at a lower price than what they're selling in China, and those margins will therefore decrease. So worth just keeping an eye out on those throughputs and bearing in mind that margins for Chinese refineries are artificially higher right now, not necessarily driven by normal supply and demand dynamics.
Thank you, Ajay, and thank you, Richard. So yes, going forward, looking at demand improvement, if we look at kind of beyond the end of the year, the question kind of like comes with, are we going to still see the same kind of jet fuel demand? Are we going to see people flying around the world as much as we used to? And also the typical driving season for the US. Ignacio, I'm not sure if you have a few words on that for us. I think you'll have to unmute yourself. Sanjay, perhaps you could help unmute Ignacio. Perfect, we can hear you now. Go ahead.
Okay. We have to remember that what's going on in today's market, we have not seen this before. And yes, it's going to be a while before demand picks up. Transportation, even driving is going to be slowly coming back because people are going to be concerned. There is, as you explained, there might be a second wave of the virus. We really don't know exactly how this is going to develop. And talk to investors. Investors are having a very difficult time trying to determine how to move where to invest, actually. And as I like to say that, for example, the futures markets in any commodity are anticipatory. They anticipate what may be happening. And the beauty of a futures market is that we have a forward curve. And if you look at the forward curve for Brent, for example, by the time we get to the September contract, October, we're in $31, $32 a barrel. WTI is a little more difficult. We don't break the $30 barrier until we get into in December or early next year. But the markets are anticipating a recovery. No, we're not going to go back to the $50, $60 range, but at least we're going to get out from under where we are now. And demand hopefully will recover and lift everything from the hole we're in right now. Thank you.
Fantastic. Thank you for that, Ignacio. And I believe with that, I think it's definitely an unprecedented situation in the market that we are facing right now, both in oil and oil products, petrochemicals, and the energy markets. It's something to kind of keep an eye on. And of course, we are available for any kind of questions you may have. I will now pass on to Sanjay for any questions that may have come up during our presentation. Sanjay, over to you.
Thank you so much, Sophie, and thank you all speakers for providing a wide coverage on the oil market. Indeed, we had a lot of questions which has come in the queue, and it is quite impressive that almost everything has been answered by all the speakers. However, I will take a few questions, and we have some questions for NSE as well, but first I will try to ask questions which our market participants have posed to the ICIS speakers. So the first question is about the assessment of ICIS. The question they asked is the computation. ICIS assessment is used in the computation of Brent Crude Index. how robust is this assessment is, and how much is it correlated to the global crude oil prices?
Okay, I will take this one. So I believe that the assessment truly reflects the market value. We are actually told by the ICE Market Oversight Committee that ICIS sees the most trades in the market more than any other PRA or any other source. Our price history goes back 30 years, and our market experts are obviously constantly following the market. They are often seen at different events, cited in major publications. Now, its correlation stands in its connection to the ICE Brent index, as I've explained previously. Our Brent expiry fixings feed into the ICE Brent index, which is obviously one of the biggest exchanges. They also feed into the NSE settlement as well. So obviously, as a result, they feature highly on requested data sets from our subscriber pool, and we do see these fixings that we deliver in real time to the market as a key, I would say, even benchmark for the North Sea market.
Thank you so much. And we have one more question, which is basically an extension of this. It says the exchange participants in the Indian market are familiar trading with WTI crude. If they have to trade Brent crude oil futures, what are the additional things they need to do or track? Any insight on this?
So I would say, obviously, we have Brent as a big global benchmark, and obviously it reacts to. It is very sentiment driven, so it reacts to very big data sets, OPEC plus. US, obviously, the WTI contracts also react to these. Particularly the EIA data set that is coming out every Wednesday, for example, today, that Ignacio mentioned. On the Brent side, I would say, because it has such strong reactions to news reports, there's definitely a need for a reliable intelligence services, and definitely to keep an eye on the big data sets that are coming, the major developments. And also, I would say Asian demand. It is a key, I would say, a key key consumption hub, I would say. So obviously that will be impacting Brent futures as well.
Perfect. There's one question which says traders with spread trading strategies between WTI and Brent crude oil. The price divergence in the recent WTI, it looks as if it's quite suicidal. So, what are the views when there's so much of price divergence?
Ignacio, given that US is your area of expertise, do you want to take that question?
Yes. The arbitrage between Brent and WTI is widely traded because it's what we call the transatlantic arbitrage. What we have to understand is that the two contracts brought them to each other, but the monthly contracts sometimes diverge. For example, when we had flash crash in May, Brent was already trading in June, the June contract. So the impact was very minimal. Obviously, it's like the tide. When the markets move, they move up or they move down. But at the same time, that crash was narrowed to the financial markets, the May contract. So by the time the June became spot month, the markets have realigned basically like they were before. So yes, an investor that wants to hedge need to be very careful trying to hedge forward months rather than be careful trading in the spot market. Hope that works. Yes.
Thank you. Just one more question, which says that for Indian corporates dealing in petrochemicals, what, according to you, is the most appropriate hedge, a WTI crude price or the Brent price?
Perhaps I can take this one. I would say it's a bit of a mix, really. We have spoken with a few. I mean, based on like information we have from market participants, it is a bit of a mix. There are a lot of imports from West Africa and from Mediterranean, which will be Brent linked, obviously. But then you still have a lot of Middle Eastern crude coming in. So in general, Brent would be the natural thing to link to. And for petrochemicals, given the connection to the key feedstocks, naphtha, Brent seems like the natural link. Now, it is true that, for example, so we have WTI more of a US specific, and basically, while we have Brent as a more of a global benchmark. However, we have heard of companies, I would say, linking to both WTI and Brent. Obviously, as I mentioned, Brent would be the natural link there.
Perfect. Thank you. There's one question which says that as the world is moving towards electronic vehicle, how will it impact the crude oil markets globally in the long run?
So I can take that question. Hopefully you guys can hear me okay as well. I've been having a few problems with my laptop just then, but if you can hear me okay, then yeah, what we at ICIS do is we have a long-term view as well. We do global oil balances for oil and refined products going out to 2050. And we update that on a very regular basis as well. And what we've seen with those balances, if we're talking in the long run up to 2040, 2050 sort of time, we have to take into account what the current plans are for national governments or regional governments as well, regarding their just general environmental policies and their plans with electric vehicle implementation and ICE, just normal cars engine removal from the market. What we see is generally most countries are claiming that they're going to ban the sale of normal petrol and diesel cars in X number of years. Some are very near, in only a few years' time. Some are up to 2040, for instance, when that ban will come into place. But regardless of that, even though the ban will come into place in a few years' time, there's a massive existing fleet of normal cars with normal engines based on gasoline and based on diesel. So ultimately, that existing fleet will still be the majority, will likely still be the majority gasoline and diesel based, even as we go as far out to 2040 and potentially even further as well. So whilst EVs is a big hot topic and is very much being talked about in globally and in individual countries as well, we have to bear in mind that oil has a grip on the world. It's embedded in every single part of our lives in various different ways, and in particular with cars, that replacement of normal traditional cars with electric vehicles will still not mean that there is going to be no demand for gasoline and diesel in the long run. So oil demand will still be there. Oil will still be required in vast numbers. Not quite the same sort of figures as we see right now, of course, but oil will be used in various different other ways instead. Ultimately, if there is a transition away from your traditional outlets such as gasoline and diesel, then there's other routes such as chemicals, and we're seeing refineries really think about that future as well, producing new refineries which simply produce extremely high yields of chemicals instead of just high yields of your typical transportation fuels. So oil demand overall will still exist in the long term. This EVs and environmental changes won't really dent that too significantly overall.
Thank you, Ajay, for answering this. There are still many questions which are flowing in, many which we have already answered. However, due to time constraint, we have to end the session. And as Ravi mentioned in his remark, that transcripts will be available, and all the other questions we will try to answer in the transcripts. Ladies and gentlemen, in the post-universal exchange regime, NSE is the first exchange in India to launch futures product based on Brent crude oil prices. After having heard to the international speakers, we understand how relevant this futures contract is. I will have one last question for Ravi. This question, Ravi, if you can hear me. We know NSE does provide innovative contracts and does plan things methodically. So why are we not launching a market making program for Brent when we understand WTI and Brent are two different contracts?
We have been working with the regulator to introduce a market making program. We are engaging with the regulator to try and get an approval for launching a market making program. As the discussion today shown, there is a significant difference between Brent and WTI crude. We will continue to work with the regulator to try and see how we can launch a market making program.
Thank you. Thank you. So with this, we will bring an end to this session. I sincerely thank ICIS team for such a wonderful session. I now request Ravi to give a vote of thanks to all our audience, please.
Thanks, Ajay. Thanks, Sophie, Richard, Ignacio, Ajay, for talking about the developments in the world, in the oil world. And it's really enlightening, and the kind of questions which we have received really show that people have fantastic interest in this area. We really thank you for taking time off and addressing our members and other ecosystem partners. I thank all our participants. We will continue to come to you with a series of webinars. Obviously, the lockdown is at least a few days away. Lifting of lockdown is a few days away. So we will continue to come back to you with a series of webinars. We are working with the Community Participants Association of India. The next webinar we are planning for Monday on topics which are of interest to you. Please continue to participate in these webinars to enhance your capacity, knowledge, skills, which would help you to trade the market in absolutely uncertain terms, times which we are passing through as of now. Thanks all. Thank you very much for participating in this webinar. Thank you.
On behalf of the whole team at ICIS, thank you to Sanjay, Ravi, Saurabh, and the NSE for hosting us. It's been a real pleasure, and thank you to everyone for watching.
Thanks.
Everybody, it has been a pleasure, and we welcome any kind of market inquiries to our editorial team and our analyst team, and any kind of customer inquiries to our local manager in India, Arun Mundra. Thank you, everybody.